Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Charlie Wise, Head of Global Research and Consulting at Transunion, to discuss Transunion's annual 2022 consumer credit forecast. Charlie, it's great to have you with us. Welcome to Trade Talks.
Thanks so much, Jill. Good to be with you.
Thank you. And did the report show that lending is expected to expand? And if so, what segments?
Yes, Jill, we've forecasted what we expect to see for consumer credit in 2022, and we do see a continued expansion in lending, particularly in those unsecured lending categories, credit cards, personal loans, that saw the biggest drops during the initial months of the pandemic. We've seen those recover, start the recovery process in 2022, and we expect to see a continuation of that in the year ahead.
What has restored lender confidence, particularly with people that may be viewed as higher credit risks?
What we've seen is consumers have been doing a surprisingly good job of managing their credit through the pandemic. We've seen delinquency rates, which we might have expected to see rise initially after the pandemic. We've actually seen them drop. And we've seen that at the end of this year, delinquency rates are really at near all-time lows across the lending spectrum: credit cards, auto loans, mortgages, personal loans. And that strong performance has given lenders the confidence to continue lending, not just across the spectrum, but really into those higher risk tiers, the ones that saw the biggest drop in lending during the initial months of the pandemic.
So what credit industries are expected to be impacted in non-prime originations?
Really, all of them to a certain extent, particularly in those unsecured credit areas, credit cards and personal loans. Consumers really saw difficulties in getting new credits through 2020 into 2021. We saw a big pullback. Lenders were worried. There was a lot of uncertainty. They weren't sure who was going to be able to manage their credit, and they've gotten increased confidence to extend new credit to those higher risk borrowers in those categories. We also see continuation of growth in the auto sector. The auto sector, of course, being a really complicated sector because of the inventory shortages, the fact that there are just simply no cars on the lots to buy right now. So there's tremendous demand in the market. There's just not the supply to move the new automobiles and used automobiles that are required to have a healthy lending market. So when we see some of those inventory shortages start to be addressed, that's when we're going to start to see a pickup. Now, whether that happens in the middle of 2022 or more toward the end of the year remains to be seen, but we do see an expected pickup in demand, and that will include higher risk borrowers who, again, are very much in demand for those vehicles.
Charlie, do you think any of this is kind of a result of what we went through during the Great Financial Crisis? Although it was, over a decade ago, where lending standards were tightened, there's been much more in terms of credit education and services that are out there for the consumer. Perhaps that's, a silver lining out of the financial crisis as we as consumers learn more about credit and lending standards were made a bit more fair. Do you think that's sort of a residual effect in what we've learned through the pandemic?
Jill, that's a really great point, because I think there's been a lot of concern as we have, we saw huge increases in unemployment. We saw big uncertainty in terms of consumer income and their ability to service their debts, and a lot of concerns that are we going to see now a revisiting of the 2009, 2010 crisis as consumers start getting back into credit markets. What we've actually seen is consumers' balance sheets are in really strong positions. We saw a big decrease in unsecured lending. Credit card balances really dropped to, recent memory lows in terms of outstanding balances. And that's due in large part to the fact that there was both a drop in spending as well as a lot of excess liquidity as the government was able to jump in with stimulus payments, enhanced unemployment benefits. Consumers had excess cash and they were able to use that to pay down their debts. Their balance sheets are in really strong position. So it's a very different circumstance from 2009, as well as the fact that consumers are now much more aware of their credit, the importance of credit, the importance of making on-time monthly payments and managing their balances. So I think the consumer is a much more educated consumer than they are today, and a much more, I wouldn't say conservative, but a much more prudent consumer in terms of their use of credit and taking on new debt.
All right, Charlie, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.